Once you choose your pension benefit, you're locked in forever. Think about that. Forever is a long time, and there really is no going back once you do that. So if you've been asked to retire recently, or maybe you're thinking about retiring around the corner, you don't want to miss a minute of today's show, because I'm going to dig into how do you turn on your pension or your retirement fund into income that'll pay you for the rest of your life. Well, don't get blindsided by making the wrong decision. So today we will get into that and help you protect your retirement. Good morning and welcome. This is Protect Your Assets. I'm David Hollander, your host. It's so great to be with you on this nice, warm, sunny day. For those of you just joining us for the first time, welcome. People around here, you hear the jingle, they call me the Sandman, and that's because I help my listeners sleep well at night by answering their most troubled tax, legal, or financial questions. And that's because I've been running that type of a firm for over 30 years. Maybe a question comes up during the week. This week was full of them. Even for me, I had a couple that I did not know what to do. I figured it out, but gee whiz, it certainly tested me this week. Questions at pyaradio.com. Something comes up, you want to know? Shoot me an email, questions at pyaradio.com. So, deciding how to draw on your retirement account, whether it's a pension, 401k, 403b, TSA. When you start to draw on that, that could be one of the most important financial decisions you will ever make in your lifetime. Because once you make that decision, in many cases, it's irrevocable. And that means that you can't go back and change it. You're stuck. There's no more do-overs. That's it. So the decision you make could have a lasting impact financially on you, of course. And what about your spouse or your family if something were to happen to you and or your spouse? The decisions you make today will last a lifetime. Don't kid yourself. So if you make the right decision, it is possible to have predictable, consistent income month after month, not only for you, but for your spouse, and maybe even your kids and grandkids. So don't do this hastily. Don't make a bad decision. And so today we're going to help you avoid that. Stick with me for the entire show as I discuss which retirement option is right for you and or your family. As always, like other radio show listeners have done, if you need help or have questions or want to find out specific advice tailored for you, check us out at our website, libertygroupllc.com, libertygroupllc.com. Got a great story when we come back about Pam, who just walked in off the street. She was working at Kaiser. She'd been there for 25 years. You're going to want to hear about this story. Got me thinking a little bit, because if she picked the wrong retirement option, well, that would have been it for her and her husband. It wouldn't have been so great. So this decision you're going to make could possibly be one of the most important financial decisions you make in your lifetime. So stay with me when we come back as we dive into the options that you have and some common mistakes that we see people make all the time. You're listening to Protect Your Assets with David Hollander. That's me. I am the Sandman, and we'll be right back. Welcome back. I am David Hollander, and this is Protect Your Assets. People around here, they call me the Sandman, and that's because I help my listeners sleep well at night by answering their most troubled tax, legal, and financial questions. And that's because I manage a tax, legal, and financial planning firm and been practicing for over 30 years. I know the financial investing world can be puzzling, with so many acronyms, terms that just make it too much to understand, so much so that some people tend to feel stuck, not knowing where to turn or who you can trust. The good news is it doesn't have to be that way, because we are here to demystify retirement planning and help you gain the confidence you need to feel comfortable about where you're going. Case in point, on today's show, we're sharing which retirement option is best for you if you're about ready to turn that retirement fund pension into income for the rest of your life. If you missed any of the opening of the show, particularly the market segment, go check out our podcast wherever you get your favorite podcasts. All you have to do is type in the search window, protect your assets, and you will see the show pop up. And just look for today's date. It'll be posted there by Tuesday. And if you like it, please tell a friend. I really do appreciate that. All right, so we have a call. If you have a question, you're welcome to call in. We're sitting around here, 808-5627, 808-KMBR. I got Colin from San Francisco. Go ahead.
Hey, David. My name is Colin. I live in San Francisco. I'm 35 years old and, thinking hopefully retiring in like 20 years or so. I've been saving quite a bit and have about like $500,000 in the account. And I've been using a target date fund, and that would come due in 2045, I believe. And I was just wondering if that's a good idea or what you'd recommend overall when it comes to target date funds.
All right. Well, hey, Colin, thank you for calling in, and good job. Good for you. 35 has saved quite a bit of money at this point in his life. Obviously, he's been doing this for a while and saving the correct way, which is great. And he's already thinking about when he's going to leave. So I hope you enjoy your work. 20 more years is a decent amount of time. And so hopefully you're enjoying what you're doing. But you asked a great question, target date funds. And so many people in their 401ks have these limited options. You have different choices of funds you can put your money in, typically in your plan. And what Colin's talking about is he's got an option that's a 2045 fund that he can just drop his account into. And the fund is supposed to be migrating towards his retirement date of 2045, if that's when, in fact, he's going to stop working. Now, a lot of people think that those are, automatic, like on a cruise control, if you will. As you're driving along, you set the cruise control for a certain speed, say 65, and the car just stays at 65. And sure, if you're going up a hill or down a hill, it may slow down a little bit, mile here, mile there, but basically it's 65, right? So it's consistently at that speed. You could do your portfolio the same way, where you're saying, look, I'm going to stop at 65, or in this case, 55, because he's 35. So 55, he wants to stop and maybe do something else with his life, and he wants to make sure most of his portfolio is there and has been growing over time at a reasonable rate. And so these funds typically will move money around between different options, so small cap growth, large cap value, different types of fixed income. I mean, we can go on and on about this, but basically they move it around, and that's the idea. So as you get closer to that date, the speed limit or the volatility you're taking in that portfolio, the risk starts to decrease. So by the time you need it to live on, it's we'll call it it's still risky because it's in the market, but it's in a safer environment because you've de-risked it a little bit instead of being so heavy in, say, more aggressive equities. Sorry, the long way to say what I'm trying to say. But anyway, Colin, if you're in a 2045 fund, I want to give you an example of some differences you should be aware of. This was taken from our portfolio MRI tool that we use. I talk about this quite a bit, where you could just literally send in your portfolio and find out what's the speed limit, what's the risk level on your portfolio. And what I found when I looked at 4 different 2025 funds, so this is a year from now, so people who might want to retire a year from now who are in 2025 funds, they don't all look the same. In other words, between now and when you want to retire, you could lose more than the other person in the exact same type of fund. So what does that mean? Well, let's say that, again, you were going to retire a year from now, Colin, and you were in a 2025 fund, and you were with the John Hancock Retire Living 2025 fund. The symbol is JLEAX. If you were in that, your risk level is a 71. Now, this is 0 to 100, 0 being no risk, 100 being something like a Bitcoin or a high tech stock that's very, very risky. That would be more like 100, 99 to 100. So somewhere in between there, your portfolio falls. That particular John Hancock fund's a 71. And according to our MRI in the next 6 months, according again to this software, that could be down 15.59%. Now, if you look at a comparable 2025 fund, and this is the Schwab Target 2025 SWHRX, that's running at a 50 risk level. And again, according to the portfolio MRI tool, that could be down about 9.59% at some point over the next 6 months. We don't know when, but that's what the predictor is saying. So think about that. I mean, that's a pretty big difference in terms of what you could be down if you were going to retire, say, 6 or 7 months from now, right? It's possible. So you would just have less capital to live off of. So, Colin, what I might suggest you do is look at all the fund options that are in your plan and then perhaps do your own asset allocation amongst those different options. So when you get to that date, you'll be more on top of it. Now, I know a lot of people say, well, I can't do that. I'm working. I don't know how often I need to do that. I don't look at it. That's where you need to find out if you can connect a financial advisor to your 401k. Today, we're talking about you retiring. And how I got to this subject was Pam came walking in. She just dropped in. And Pam has been working up the street. You know, I'm right here in Oakland right now, downtown Oakland. Here we are. It's a beautiful day. And Pam worked at Kaiser's, came walking in, and she'd been there about 25 years. Now, she has a 401k, and she's been contributing to it diligently. Much like Colin who just called, she's got her own allocation, and she's been on top of it and been doing a good job accumulating money. She also has a pension because she's been there so long. So she has a pension statement with options on it. And she's 64 years old. Her house is paid off. She's married to Joe. And the two of them together need about $20,000 a month after tax to maintain their lifestyle here in the Bay. They like to travel. They have a little bit of fun. They have some kids, grandkids want to take care of these folks. So that was her objective. So she came walking in and showed us all this and just said, I don't know what to do. I'm good at saving, but I don't know how to turn this into income, and I don't want to make a bad decision. What are my options here? Because I'm thinking about leaving in about 6 months. So I want to break Pam's case down today in a couple different things to think about, because this is what we do every day. This is how we help people, and I want to help you. So let's back up and remember Pam's 64. What does that mean? Well, it means she's not going to be eligible for Medicare for how long? You're right, 65. At 65, she becomes eligible for Medicare, which means that part of her health care will be covered by the government because she's paid into this system. She works for Kaiser, who has great health benefits for their employees, and so she's going to most likely be in good shape there. But, again, with plans being redone and benefits changed all the time, how likely is that going to be the case? Well, maybe pretty good. But anyway, we can factor in Medicare to the equation. We need to know that because if she retires before 65, she might have a gap there. So that's the first thing. Second thing is with this pension option that she was presented, they gave her some choices. And you may see this if you have a pension. What is that? Well, you might be given several different payout options. And typically what I see, like Pam, she came walking in, and I'm going to give you some numbers here. She was offered $5,528 a month for the rest of her life if she went with pension option A. They gave her another option, which is if she wanted a certain fixed amount for 5 years, meaning that if she lives for at least 5 more years, they're going to pay her this. And if she continues on for life, they'll keep paying her this amount. But if she were to die, say in about a year from now, they'll pay for at least 5 years. You follow me? So that's called a 5-year certain. $5,483. Notice the difference? $5,528 if you have no guarantee of a term, $5,483 if you ask for 5 years. Well, that's less. Well, that's right. If you want some guarantee, you're going to pay for it. 10-year, 53.52. 15-year, 51.32. 20-year, 48.34. All right, so you got some different numbers there. Hopefully you wrote those down. And she had what's called a lump sum option where she could just take a chunk of cash, pull it out of there and do whatever she wants. That was $904,464.83. Now, what I found very interesting about this pension statement is there was no joint spouse option. You heard me right. So she's married and there was no way to get a 75% payout to her spouse if something happened to her during her lifetime, or a 50%. You see that very commonly as well. And a lot of times people ask me, what should we do? Well, the first thing that we did is we said, well, hey, Pam, you're in really good health, right? Yes, excellent health. Nothing wrong with me. Get checked out regularly. I'm in good shape, ready to go. Mom lived to be in her mid-90s. So, Pam could be around for another 30 plus years. It's possible. And statistically, because her and her husband are here today, one of them statistically is going to make it to 90 or greater. That's right. A 65-year-old couple today, married, have a great possibility of one of them getting to 90%. So you don't want to mess around with that. So we're talking at least 25 years. So what should she do here? Which pension option do you think she should choose? Let me give you some more facts to consider. When you do look at monthly payout options, here's what pensions historically use as a return rate when they do their projections. The number is 4.5% to 7.5%. And once the benefit starts, they assume a 10-year benefit period. Those are the math that goes into typically the actuaries who calculate this stuff. But in Pam's case, the reality here, again, because she's in her mid-60s, is that she's going to be around a while. So these historic numbers I'm talking about may not make it, may not do it for her and Joe. And that's where she can get into trouble, particularly if rates, say in the next 10 years, are lower than where they are today. Because now she's going to be looking to get money off that money in a much lower rate environment, potentially. I see the risk here. I mean, these are the things that you have to think about. Now, on the other hand, she could take the lump sum. She could take the $900,000 and $904,000 to be exact, and she could invest it in her own account. Or she could try to create her own pension. And in Pam's case, I'll just get right to it. That's what we did. We went out and we looked if we could create our own pension for her. What could we get her? We were able to get her $56.25 a month. So that was better than the $55.28, which was good. But the best part about that decision was she still, and Joe still, had access to the principal. So even though we were creating this pension for her that was paying her more monthly, if something happened 2, 3, 4 years down the road, she or her husband or her kids still had access to the remaining part of that principal that they were drawing down on. So you didn't lose it all. With the pension option, the highest pension option we talked about, the 5528, if she elected that, when she chooses that, that's an irrevocable decision. You can't go back and touch any of the $900,000. It's gone. So in other words, if she lived about 6 months and got hit by a truck, God forbid, it's gone. That's it. No one gets it. Joe doesn't get any more. Kids don't get any more. You just lost well, you spent some of it obviously over that time, but you'd get me about $870,000, $880,000 gone. Where? Well, Kaiser and their fund that pays for this stuff. Yeah. And those are the decisions that can affect you and your family. So you don't want to take this lightly. You want to be careful. And you got to ask yourself this question: what would your spouse do if you chose that option and you were wrong and now something happened to you and you're gone? And now she gets zero, or in this case, Joe gets zero from that pension that you both were counting on. Think about that. Pam didn't. We brought that up to her, and she said, whoa, I didn't know that. Because naturally, she was gravitating towards that highest payout amount, right? Of course. So then the next question, is Joe going to be forced to sell the home? Coming up next, it is time for our popular They Say segment, where they say, your pension can't go bankrupt. Is that really true? And if so, what would that mean for you? You're going to be surprised at this one. You're listening to The Sandman on the Protect Your Assets show. We'll be right back. Welcome back. This is Protect Your Assets. I am David Hollander. People around here, they call me the Sandman. And that's because I help my listeners sleep well at night by answering their most troubled tax, legal, and financial questions each and every week. And if you've just turned in deciding on how to draw down on your retirement account, whether it's a pension, 401k, 403b, this is one of the most important decisions you could make during your life when it relates to your finances, because sometimes you make a decision and it's not changeable. Meaning once you've signed those papers and you're out the door, that's the wrong time to be getting financial advice after the fact, because maybe you're stuck and you can't go back. And we had Pam walk in this week and she was facing that exact situation. She's with a great local company, Kaiser. They had good benefits for her, good package. And now after 25 years, she's getting ready to pull the trigger and she just got decimated with all this paperwork and didn't know what to do. And this is someone who's pretty savvy when it comes to investing, but just really didn't know how to approach this option that she was faced with that was pretty significant when it came to her pension. So once you make that decision, typically on a pension, it could be irrevocable, and that means you can't go back and fix it. That's it. So remember, once you do these things, make sure you know as much as you can before you actually sign that paperwork. So what's the right decision for you? Well, we're going to cover that today. We've been talking about it during the show. If you missed any of the show, go back and check out our podcast. You just type in Protect Your Assets where you get your favorite podcast, and you will find the show, and you can listen to the segment perhaps you missed. Now it's time for one of our fan favorite parts of the show, our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say. All right, so here's one they say. They say that pension plans are preserved and sustainable, and you shouldn't worry about your pension going under. What do you say? Is that always true? Unfortunately, no, it's not true. In fact, all my 30 years I've been doing this, I've seen a few times where some folks walk in where they had a pension and it was paying a certain amount, and next thing you know, they get a letter and it's talking about how the money's just not there and their benefits are going to get reduced or possibly cut, and they wonder, what do we do? You may have read articles. There's been some out there in the newspaper. Well, let's get into it. Nearly 1 million working and retired Americans are currently covered by pension plans that are in imminent danger of insolvency. This is according to the Daily News article, and you can go check it out. Since that study was released, we've seen some market declines, some market rises. We've seen interest rates going up. We've seen inflation going up and now coming back down. So these sort of things compound the problem when monthly benefits are due and have to be paid out to employees who earned them. So what happens if a pension plan is unable to pay the benefits that it's promised its workers? Well, there's another study you can read, the Heritage Foundation. According to them, the Pension Benefit Guaranty Corp, that's called the PBGC, which is similar to the FDIC, found, again, this is the Heritage Foundation, found that for a promised benefit of $24,000 a year, that they're insured up to $12,870. To compound that problem, this insurance has the same problem as FDIC, in that FDIC has billions in reserves, but has exposure to trillions of dollars in bank accounts. Exactly. The same issue exists within the PBGC, again, the Pension Benefit Guaranty Corp, because if it goes insolvent, that $12,870 promise is really only able to cover $1,500. So that's the reverse logic there. And obviously the concern is if you're retiring and you're counting on that income, that payment for the rest of your life, what will you do if it stops coming in the amount you expected or it gets reduced? Well, that's where you might have your 401k to rely on, or a 403b or a 457 if you work for the federal government. Any of those types of plans will be around, hopefully, because you've invested it, you've been prudent about it, and you've looked at it, and you're using it to grow maybe more of your risk money. So what could you do if you leave your your work and you want to manage that money? You could roll that over to an IRA, that 401k. You could roll it over. Some people cash it all in. After all, the market right now is at all-time highs. What's wrong with cashing it all in, walking away from the table, so to speak? Well, that is an option, but you should only consider that if you have an immediate need for that much money. Because remember, that withdrawal is all 100% subject to ordinary income taxes. And if you're under the age of 59 and a half, there could be an additional 10% early withdrawal penalty on top of the income taxes that you'd have to pay. So the IRS allows you to withdraw money if you've stopped working for your former employer in or after you've turned 55, like my caller earlier, Colin, who's thinking about retiring at 55. However, that exception won't apply. You don't need to worry about it if you roll it over to an IRA. So if you run into a crisis, maybe the pension stops or there's a reduction and maybe you have some tough finances right now, your kids are asking for some money and you don't know where you're going to get it from, or maybe something broke at your house you need to fix. All these things could come up and you need some additional capital. Well, you could maybe do a loan against your 401k. A lot of 401ks have the ability to take a loan, and as long as you pay it back within a certain period of time, then you don't have to pay that tax. So if you're looking at options, you don't know what to do, where you're going to get your money from, how's it going to come, how much is going to come each month, this could be overwhelming. Coming up next, find out the one secret you can use right now to get the most out of your retirement account. It's coming up next. Don't miss this one. We'll be right back. Welcome back to Protect Your Assets. I'm David Hollander. People around here, they call me the Sandman. And that's because I help my questioners, listeners, whoever you want to call it, walk in the door, people, Pam, answer their most troubled tax, legal, and financial questions. We've been doing this for over 30 years. So Pam walked in and she had some great questions, and I know it's confusing, but I'm glad we helped her out. We're able to clear up the problems she was facing and get her set on the right path. Today we've been talking about if you're getting near retirement or in retirement, which option is best for you. Some strategies you should think about. So we've been covering this morning. If you missed any of it, go back and check out our podcast, Protect Your Assets, and learn more. And so before the break, we were talking about your retirement account. And usually you have a pension or a 401k, 457, some type of retirement account that you're relying on to live on. And this got all started because Pam walked in the door this week from Kaiser, had a bunch of different options, and didn't know what to do. And her and Joe were expecting a certain amount of income. So we sat down and we went through it. And one of the options that she was considering was rolling over her 401k. Now, these are some things, again, very high level, I'm going to cover that you might want to consider if you're going to roll over your 401k. First, what are the investment fees? What are the fees where they are now at the 401k? What would they be if you rolled them? Make sure you compare those. Next, the investment options. What are the choices you have in the plan right now compared to if you rolled it to an IRA? What would they be there? Third, convenience. If you have multiple 401ks, you know what I'm talking about. Maybe you've had 3 or 4 jobs over the years and you got different 401ks at multiple employers. How easy is it going to be for you to manage all those and to use certain buckets of money over periods of time to live off of? That's the first question. And second, what about your beneficiaries? Are all those actually the way you want them? When was the last time you looked? Creditor protection. Generally, 401ks in California are protected from your creditors. IRAs, not so much. So if you're someone who's got some asset protection issues, another consideration to think about. Next, flexibility. Many 401k plans may not allow you much flexibility when it comes to taking your money out. Did you know that? For example, more than 30% of 401k plans disallow periodic or partial withdrawals by their retirees. And about 36% disallow installment payments, according to the Plan Sponsor Council of America. So if you don't know, ask your HR department about what the policy is when it comes to getting at your money. Next, company stock. I see this a lot with 401ks, particularly in the Bay Area. A lot of companies give stock as a benefit that you have to earn over time. And sometimes that stock gets placed in your 401k. Now, this is a big one. A lot of people make this mistake. I see this a lot. Stock that's in your 401k can, you heard me right, can get a tax benefit for keeping those in your plan rather than rolling that to an IRA. This is a big deal. This is called net unrealized appreciation. You may want to write that down and research it and find out more about this. The basics about it: by keeping stock in your 401k, you'd ultimately pay preferential capital gains taxes over ordinary income. That could be a huge advantage for you. So think about that. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. Kevin Renfer, Phil, Dylan, Raff back there all doing the hard work. Thanks, guys, because without my team, I'm just another pretty voice on the radio. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.